again, Invesco Mutual Fund joins in on the show. Vetri, hi, good morning. It's a very auspicious day for us. It's our 16th birthday. So, you know, we're celebrating today. But the markets have been celebrating only one thing, and that's individual stock movements in the mid-caps and the small-cap space. That's where all the action really lies. Do you think that trend will continue, that this will continue to be a bottom-up stock pickers market?
Well, first off, sweet 16, so happy birthday to all of you.
Thank you.
CNBC TV 18. I think it's been a wonderful 16-year innings, and look forward to more of it. I think as far as the markets are concerned, if you look at it, over the last 12 months, you've had the Sensex, which is down about 7 or 8%. And you have the mid-cap index, which is, in positive territory by about 4 or 5%. So it has been a challenging market. I would say, even if you look within the large cap index, there are names which are up and there are others which are down quite sharply. But, at a portfolio level, beyond a point, you can't really keep getting the benefit of only stocks which are moving up because you have a diversified portfolio. So it has been a challenging market, I think, for, any fund manager this last 12 months.
Oh, yes, it has been. And I guess those of you who are managing mid-caps have been doing very well. Actually, let's look at themes that you might play in 2016, Vetri. We just had Ramesh Damani speaking about financial inclusion, and over the weekend, Bill Gates was there speaking about it. Is that a theme you will play? I notice you have Aditya Birla Nuvo in your pack. Is that a theme that you will play at all, financial inclusion? If yes, how? Which stocks?
I think it's still early days for that, Lata. Without doubt, I think what's happening in the banking sector at this point of time is sort of unprecedented, because if you look at it, banking has been one of the few sectors with, barriers to entry, simply because the regulator didn't allow anybody to come in. So it's been one of the few sectors where there have been limited new entrants over the last 20-25 years of liberalization, and those that have executed well have grown very significantly. Now, for the first time, they're getting a whole new set of entrants, small banks, payment banks, and potentially at some point of time licenses on tap, as the RBI has suggested. So I think for the first time you're set to see competitive intensity go up dramatically in the banking sector and financial sector. But it would be a bit presumptuous for me at this point of time to give you a very clear sense of where we think companies will lose out or will benefit. But I certainly think competitive pressures will go up, and as we have seen in every other sector post-liberalization, consumer choice improves, competition goes up. Overall profits may go up, but profitability starts to come under pressure, and weak players really get sidelined in this. So we continue to back some of the financial names that we think are well placed, both in terms of the quality of the liability franchise and the quality of their assets. But I think the next 2 to 3 years will be very different from what we've seen in the past. But I don't think at this point we have a specific view on specific companies because of this. You mentioned Aditya Birla Nuvo. I mean, we don't really talk specific stocks. But it's a combination of two businesses. One part of it is Pantaloon Finance, fashions, and the other part is the financing business.
Would you buy into, or would you recommend long-term investors buy into some of these beaten down A-grade pharma names, the likes of Sun Pharma, Dr. Reddy's, etc., that have had really sharp knock this year?
Well, when you say beaten down, you have to actually see what you mean by beaten down. I mean, if you mean the stocks are down 30-40%, maybe in a few cases from their peak, yes. But if you look at a valuation basis, it hasn't really compressed all that much. I mean, these stocks are still pricey. They were trading at a huge premium to their long-term valuations at the start of the year. But earnings have seen massive cuts for some of these companies due to FDA-related issues, product-specific issues. And therefore, now when you look at the numbers on 16 and 17, they're still actually pretty pricey, and they're trading above their long-term averages by a wide margin even now. So from a valuation perspective, it's not an area which we think is still particularly attractive. And there are a lot of company-specific issues that these companies will need to navigate before we get a lot more clarity. But my basic issue is valuations.
Vetri, this year, the year that's just coming to an end, has not been a great friend for large caps, not for those who bought Nifty ETFs, for instance. for instance, but certainly for those who have put in the right mid-cap funds, would that be, should that be the choice as investors look at their mutual fund portfolios for next year?
Well, I hope investors would be guided more by where valuations are rather than by looking at the rearview mirror in terms of where returns have come from. Because if you'd used this rearview mirror in the middle of 2013, you would have chosen not to invest in mid-caps, whereas at that point of time, the mid-caps were very cheap. They were trading at a significant discount to the large caps.
That is why I'm asking you,
And they were also trading at a discount to their historical average. So the simple answer, Lata, is that don't look at the rearview mirror, look at where valuations are, and the fact of the matter is that valuations on the mid caps are now at a premium to large caps. So if you were to ask me, it's not the most attractive at this point of time. Maybe it has momentum, but if I were to look at it from a valuation perspective, it's certainly less attractive than the large caps. Not to say that the large caps are cheap, but just on a relative basis, the mid caps are certainly not attractive.
What would be the big themes of 2016, sectorally or as close as you can get to hinting at stocks?
So, you know, the market has different moods. There are times where it's a lot more top-down, it's a lot more macro, it's a lot more sector-driven. Our sense is at this point of time is that, look, India is well positioned in terms of macro. We do believe that the economic cycle will start to improve as we go ahead. But, you know, if you read the RBI monetary policy last week, it's pretty clear, as they themselves point out, that there are significant weak spots and issues that we need to deal with. So our thought process really at this point of time is more about backing individual companies that we think can come out of this difficult period with their feet on the ground in a strong sort of fundamental position, both in terms of their business and their financials. And we think those are the companies that will get the benefit of the recovery as and when it happens. So we'd still recommend that it makes sense to be a lot more stock specific than to think about it in terms of themes. Having said that, you know, we do recognize that corporate earnings growth in India has been mediocre for the last few years. It's been running at single digits. Our sense is that if there is a recovery and earnings growth were to accelerate, it would primarily have to come from cyclical areas. And these cyclical areas could be financials, consumer discretionary, industrials. But given where valuations are, we still think the discretionary and financials is slightly more attractive on a relative basis as compared to industrials. So you need to have a little bit of a cyclical theme in your portfolio to benefit from the upturn, but be cautious about the valuations that you're paying for that upturn.
Okay, that's sage advice as we stand on the cusp of 2016. Vetri Subramanian, thank you very much for joining us on what's a very, very special day for us.